Hi folks, welcome to the Tuesday class. So, video only today, what can you do? But where were we? We were talking about money supply, and we talked about how central banks can increase the money supply. They increase the money supply by printing money, either physically printing the euros or creating it electronically, since they have the authority to do that, and then getting it into the economy. And the way they get it into the economy is they buy something, and typically they buy government bonds from the open market, not from the government directly, but from people that have those government bonds already. This is called an open market purchase. They're buying something, so they get the something, the government bonds, and the money goes into the economy, and then people deposit it in their bank, the bank lends it out, et cetera, and through the money multiplier, it becomes a lot larger amount in the money supply. So I want to talk about how you decrease the money supply. And decreasing the money supply is conceptually a little harder because you're not just creating the money, right? You need to somehow get the money out of the economy. You need to get people to give up the money that they've got. And you may know yourself that, giving up money is not something we do voluntarily very often. So how do we do it? Well, there's a number of ways we could do it. They could just take it, right? They could just take it at gunpoint like they take taxes. But as we said last time, people aren't going to be happy with that. We're kind of okay with it with taxes because we know that there's a need to fund government services. And as a society, we think, yeah, that money should come from somewhere. People got to pay their taxes. It's not something we like, but you got to do it. And so people are okay with that. Not thrilled, but okay with it. You don't rebel, how dare there be taxes at all. It's more like, I wish I wasn't paying as much and you were paying more, but yeah, there's got to be taxes. But if a central banker does it, central bankers are not elected by anybody. He's just the guy who decided we want the money supply decreased. And then you're coming and taking people's money. They're not going to be thrilled. So that's not going to work out really well. Central bank would not last long if that was the way they did it. But there's another thing they could do, right? The central bank, we said, is because the money supply is so much tied up in the banking system, central bank is also involved in regulating the banks, the primary regulator of banks. And so one thing they could do is they could just say, well, everyone's got their money in the bank. Everyone just will take 1,000 euros off of everyone's bank account balance, or 10% off of everyone's bank account balance, and that would reduce the money supply. And that would work perfectly. Well, it would work perfectly once, right? Because if you had all your money in the bank and then someone took, and then the central bank took 1,000 euros, that's horrible, you'd hate them. But you'd also make sure you took all your money out of the bank immediately, right? And so everyone would take their money out of the bank immediately so that the central bank couldn't take it again. And so, yeah, it works, you decrease the money supply, but you can only do it once, and then the entire banking system collapses. It disappears because nobody has money in the bank, okay? Which I guess is fine, except the banking system is something that's very useful for us. It's actually, we like to complain about banks, and I'm first in line on that, but in fact, the banking system does something really important. Because all the people like you and me, we have little bits of money, right? We got maybe a few hundred, a few thousand euros. Maybe we have 20,000 euros, but we got small amounts of money that you can't really do anything major with. You can't start a restaurant on the money you got in your bank account. But what the banks do is they get everyone's deposits, all those little bits of money, and once you add up all those little bits of money, then you got some real cash, right? And then you can loan money to people for homes. They can buy a house. They can start a business. And so the main function of the banking system, why we want a banking system, is because it aggregates all these little tiny bits of money into chunks that start to be usable. And so if you're IBM or Hewlett-Packard or some Unilever or one of these giant companies, you've got a number of ways you can raise money. You could go to the bank and borrow money, but you can also just issue bonds directly, right? And so for these guys, it's not super important. It's nice, but it's not super important. But for normal sized businesses, like you want to start a restaurant or you want to, you're not like a Fortune 500 company and you can't, issue your own bonds, but you can borrow from the bank. And so a lot of small, medium-sized businesses, even some large businesses, but a lot of small, medium-sized businesses really rely on this money from the bank. And that comes from aggregating all of our little bits of money. So you definitely don't want to kill the banking sector, because that means it's going to be very hard to start new businesses, and the vast majority of new jobs come from small businesses. So you'd kill that off, right? So you can't do that. So technically you could do it, but you'd only do it once, and then that would be the end of the banking system. So we don't want to do that. We want banks to be safe. We want them to be reliable. You want people to feel like they can put their money in, and they want them to be making useful loans. So we don't want to kill off the banking system just to decrease the money supply once. So we can't force people to give their money up, so we have to encourage them to give their money up. And the way we do that, and this is not probably a shock at this stage, is we do the opposite of what we want to do when we increase the money supply. What we do is we try to decrease the money supply. We need to get people to give us money, so we need to sell them something so that they'll give us the money, right? And so we sell something, and when we sell the something, we get the money, they get the something, the central bank gets the money, they get the something, and we've taken that money out of circulation, and we burn it. We shred it, we burn it. If it's physical money, if it's electronic money, we just delete the line item, and it's gone, okay? Not a worry, because we have the ability to create more money when we need to. So that's what we're going to do. We're going to sell something. And then, of course, the question is, what should we sell? We can sell anything, right? We can sell, for example, massages. Central bankers could line up on the street corner, and they could say massages, give us your money, we'll give you a massage, and that would work. You go there, you get a massage from the central banker, and then he takes your money and burns it, and that reduces the money supply. Works perfectly. Couple of problems, of course. Nobody wants a massage from the weak little fingers of a central banker. You want someone who knows what they're doing. Go to too many years of economic school or investment banking school, and it doesn't make you a good masseuse. And so that's a problem. And of course, it doesn't scale. It's very hard to sell 100 million euros worth of massages in a weekend. Very tired central bankers. But I put this here because in principle, it doesn't matter what we sell. We can sell a service, we can sell a good, we can sell whatever we like, right? We could sell real estate, we could sell stocks if we like to, and that would be fine, that would work just fine. But of course, we don't really want the central bank being in the real estate business. We really don't want the central bank owning companies, and so typically what we do is we sell government bonds, because normally we're increasing the money supply. So we're buying government bonds all the time. We got a giant stack of government bonds. If you want to sell something, sell the government bonds, right? And so you sell them not to the government, you sell them to ordinary people, pension funds, investment houses, insurance companies, and ordinary people like you and me who just want to buy a bond, okay? Okay. So to decrease the money supply, we sell something. In particular, we sell government bonds, typically. Not always, but typically. And this is called an open market sale. It's a sale. We're selling the bonds, and we're selling them on the open market. We're not selling them to the government or anything. We're just going out and seeing who's willing to pay the most for them. You can go tomorrow and buy government bonds that are being sold by the central bank. You won't know who's selling them. You'll just know that somebody's selling them. Might be the central bank, might be someone else. It's just, you go to your broker, say sell it, he goes to the clearinghouse, and they clear the market. Right? But no government involved in this, right? You're just selling it to whoever. Okay. And of course, this goes through the money multiplier as well, right? We sell the government bond. What happens? Sell the government bond, someone has to take money out of their bank account to pay for that, right? So someone takes 100 euros out of their bank account, well, let's say more like 10,000 euros out of their bank account to buy this government bond. We take the 10,000 euros, we burn it, money supply has gone down by 10,000 euros. But at that stage, the bank is has a problem, because they have 10,000 less in deposits, right? Which means that they have a lot of money loaned out, but they don't have that came out of their reserves. And so now their reserves are too low. They need to increase those reserves so the required reserve ratio, right? They have the same number of loans, but now their reserves are lower. they need to get some of that money back. And so what happens is when people start paying off their loans, they don't loan that money out again. Okay? And so when they don't loan that money out again, that decreases the money supply. And it goes through the same multiplier, just in reverse. Okay? So if you want to start a central bank, what you need to do is you need to give them a big stack of government bonds to get going, just in case they want to decrease the government, the money supply. And you need to give them the power to either, physically print euros or to create them in the banking system, which is usually how they do it. I just make them up because they can print them. And so you need to give them this power. You give them the printing press. You give them the stack of bonds, and then they can control the money supply in this way. Okay. Yeah, I'll talk a little bit more about the institution of central banks in a minute. So if we think about how much money supply there is in this story, it's really just the central bank picking what the money supply is. It's not like a whole series of decisions. It's just sort of one guy, actually a committee of people, but that committee of people just decides what the money supply is. And so there's no curve in the normal sense. It's just whatever they pick it to be. And so they can make it higher, they can make it lower on a whim. And so the money supply is just a vertical line at whatever amount they pick. It doesn't necessarily have anything to do with the interest rate. Now they could decide to choose it based on the interest rate, but they're really just picking it. And so they can pick any level of money supply they want. If they do open market purchases, they're going to be buying stuff that's going to increase the money supply, and the money supply will shift to the right. If they decide to decrease the money supply, they'll do open market sales, take the money from that sales, burn it, and that will decrease the money supply. So they can just move this curve right and left on a whim. And a bit of mechanics to do it, but it's really just on a whim. Okay. So now we have to put them together. We got supply, we got demand, we got the price of money, which is the nominal interest rate. So now we just have to put these things together. And so to do that, you see supply and demand. You got a line going up, you got a line going down, magic point where they cross. It's exactly that. It's just supply and demand, just like supply and demand for shoes or for anything else. All right, so we put them together. We've got money demand, the lower the interest rate, the more money people want to hold, and money supply, which is just whatever the central bank picks as the money supply. And then we look for the point where money supply is equal to money demand, and that is going to be the equilibrium interest rate. And so now if we want to change the nominal interest rate, all we have to do is shift the money supply. Right? Just pick a new money supply. And so if we want to, for example, lower the nominal interest rate, right? Because we said there's going to be a connection between the interest rate and investment. We suggested that earlier. And so we wanted to lower the nominal interest rate, maybe to encourage more investment. The firms are comparing the value of building a factory versus the value of buying a government bond, for instance, and getting the nominal interest rate. And so if we lower the nominal interest rate, that government bond looks less attractive. In English, that's investment, but in economics, it's not. That's just moving money around, right? And so if the nominal interest rate goes down, buying a government bond becomes less attractive, and instead the company may buy a factory because the return on the factory isn't so high, but it's higher than that nominal interest rate. So if we can lower that interest rate, we can encourage them perhaps to increase their investment. So suppose we wanted to do that. We're in bad times, we want to increase investment, we need to lower the nominal interest rate. All we have to do is increase the money supply. So you increase the money supply, and then the equilibrium nominal interest rate goes down, and that hopefully will increase investment. I say hopefully because investment actually depends on the real interest rate, not the nominal interest rate. And so what we're doing is we're increasing the money supply, and that's lowering the nominal interest rate, but it's also likely to lead to inflation, right? If we just print more money forever, like interwar Germany, we're going to get hyperinflation. And so eventually, if we keep printing money, we're going to get inflation. And remember, the real interest rate is the nominal interest rate minus the inflation rate. And so what we haven't done yet is we haven't taken into account inflation in anything, which is going to be next week's section. But suppose that inflation stays constant. Suppose we're in the world of Keynes, where prices are fixed in the short run, And so then any change in the nominal interest rate is also a change in the real interest rate. So if we lower the nominal interest rate, we are also lowering the real interest rate. So then when we increase our money supply, we lower the nominal interest rate, which means that the real interest rate went down, which encourages firms to invest more. So we might want to do this. Okay. So here, if we want to, for example, lower the nominal interest rate, we increase the money supply. If we want to raise the nominal interest rate, we just decrease the money supply. And so we can think of firms of the central bank as changing the money supply, but we can also kind of think of them as changing the interest rate, because they're really the same thing. You have this money demand curve, and you're just picking where you're going to be along it. You can have high money supply and low interest rates, or you can have low money supply and high interest rates. Your choice. You just pick where you want to be on that money demand curve. So you're really sort of picking the same thing. Okay. Okay. And so this is, like if you look at the financial press, you'll always see things like the central bank raised the interest rate from 4% to 4.02% or something like that. Or they lowered the interest rate from 1% to 0.75%. And they always talk about it in terms of changing the interest rate. But that's not actually what the central bank is doing. If we can go back, sorry, get the slide screwed up. Here we go. If we look at the thing, what they're really doing is they're changing the money supply by these open market sales, open market purchases, right? And so, but we talk about it in terms of setting the interest rate. And that creates confusion in people's minds. People start thinking that the central bank decides on the interest rate. And that isn't true. I mean, it's true in a sense that they do decide on the interest rate, but it's not what they control. It's not like they tell people what the interest rate has to be. What they do is they control the money supply until people want to choose the interest rate that they want them to choose. So you're just changing the money supply until the equilibrium market interest rate is what you had targeted, right? Now we don't talk about it that way. We don't talk about the central bank increased the money supply by 400 billion. We don't say that because that number doesn't say anything to you. Is it 400 billion a lot? Is 400 billion a little? How does that affect your life? God only knows, right? Nobody knows what that is. I think probably the central bankers, some of them probably know, but the head guys probably don't, and probably don't even care, right? Because they're not really honestly concerned with the money supply in and of itself, just as you and I in our daily life are not concerned with the money supply in and of itself. What they're concerned about is this interest rate. And when we report it to you and me, this is a number we understand. Like maybe you guys don't because you haven't borrowed a lot of money, but people who have borrowed to buy a house, for instance, or borrowed to buy a car, understand that when you're paying 5%, your payments are one thing. When you're paying 8%, your payments are something else. And you can calculate how that affects you in your life. So saying that the interest rate went from 2% to 3%, that is something that you can compare to your life and compare to the decisions you're likely to make. And that is actually what the central bank is concerned about. Which interest rate is they're going to be? Do they want to lower the interest rate? Do they want to raise the interest rate? And they say, okay, inflation seems to be taking off. Let's raise the interest rate a little bit to try to control inflation. And they cut back on the money supply. Or things are going badly. We're going into a recession. Let's lower the interest rate to try to encourage investment. Well, how much do we have to lower the interest rate to encourage investment? We think about 0.5% would encourage enough investment. And so they really say, let's take it from 3% to 2.5%. And they talk about this amongst themselves. So this is how they talk. Which interest rate should we pick? They're not like they're really authoritatively telling everyone to have this interest rate, but then they say, okay, it should be 3.5%. Let's change the money supply until we get that 3.5%. Right? So we can think of them as choosing the money supply, which is what they're actually doing, or we can think of them as choosing the interest rate, which is also kind of what they're doing, but a little indirectly, right? But they can still pick whichever interest rate they want. And so that's sort of a more useful way to think about it, but it just has this danger of causing confusion for a student and for other people as well. that you start thinking that they have some kind of law that says this has to be the interest rate. But that's not the deal at all. They're just choosing the money supply until they get the interest rate they want. And in fact, if you think about this money multiplier, they kind of have to do that. They can't really say, let's increase the money supply by 400 billion. Because what's going to happen is they're going to say, let's say they want 100 billion, and we have our 5% reserve ratio, just what we had in the money multiplier. So we know the money multiplier is 20. But what's going to happen is they're going to increase the money supply by 5. That person's going to have five more in money. And then he's going to put it in the bank, and the bank's going to loan it out. But that doesn't happen instantly, right? It takes a while for the bank to find a borrower. And so for a while, the money supply only went up by 5 billion. But then later on, they loan 90% of that out, and then an extra 4 billion goes into, no, 4.5 billion goes into the economy. Now it's up to 9.5 billion. That person deposited it, and after a while, that'll be loaned out. So this money multiplier is a real thing, but it's not instant because it really involves these banks lending and it being redeposited and lending again and being redeposited. And all of that takes time. So what the central banks do is they increase the money supply until they get to the interest rate they want. And then they just watch the interest rate. And if the interest rate goes above that, they increase the money supply some more. And if the interest rate goes below that, they decrease the money supply. So they're really just watching the interest rate and changing the money supply to keep at that target interest rate. And they have to do this dynamically because all these multipliers aren't instant. They take time, and it takes different amounts of times in good times and bad times, right? In good times, it's very easy to find people to borrow money, whereas in bad times, maybe finding good, solid borrowers is more difficult, and you're more worried that people are going to go under and not be able to pay you back. And so the amount of time it takes for this process to happen can change over in different conditions. And so really, they just sort of pick an interest rate, target that, and play around with the money supply until that they get that target. So it's really useful and legitimate to think about them as choosing the interest rate. It's just, it can confuse you on what mechanically is going on. Mechanically, what's going on is they're choosing the money supply, but they're doing it to get the interest rate they want. Okay. Another thing I want to say about this, and this is just to bring a little more realism in. If you think about it this way, this is very useful, this is correct, but of course the real world is more complicated than that, right? It's always more complicated than that. And so we can think about how it's done a little more realistically so if you wanted to lower the interest rate over a long period of time, this is how you would do it. You would change the money supply. But there's sort of two caveats to this that I want to bring in. The first one is that they've got other tools other than just open market sales and purchases to do this with. They have the interest rates that they charge banks if the banks want to borrow from them, and then they have the interest rates that they give to banks if banks want to save with them. So, for example, you're a bank, you're running a bank, and you have 100 million in deposits, meaning that you have to have 5 million in reserves, right? Assuming this 5% reserve ratio. So you're required to have 5 million in reserves, and 95 million can be loaned out in various risky deals, right? And so there you are. You're going along, and everything's fine. And at the end of each week, honestly, at the end of each week, you have to show your accounts to the central bank showing that you have this 5 million in reserves. You don't do it every day because sometimes people withdraw a little bit, sometimes they deposit a little bit. So even if you had 5 million, you might be a little high, a little low on any given day. So at the end of the week, you need to show that you've got the money. Right? There's checks every day as well, but by and large, the weekly checks are the sort of where it all comes to a head. Right? So going along, and you're targeting having 5 million, what you're required to have on reserve, so in cash, right? And that's great, but just as you're coming up till the end of the week, somebody deposits a whole load of money. And so now you have an extra 100,000 in there. So now you have 5.1 million in reserves. You only wanted 5 million in reserves. Now you got 5.1. Well, that extra 100,000, that's kind of a loss, right? It's not a loss, but it's not doing you any good. You're not making any money off of this money, right? They put it in your bank, and you didn't loan it to anyone yet. what do you do with that? Well, one thing you could do with that is find some other bank where somebody just withdraw more than they expected. And so that bank was supposed to have 10 million in reserves, but it has 9.9 million in reserves. Its reserves were just low because someone took money out at the end of the week. It was targeting the right thing, but it was just low. And so you could say, hey, you're short 100,000. I got 100,000 extra. Why don't you borrow this 100,000 from me over the weekend? And they'd say, great, that keeps me clean with the regulator. The central bank's not going to get mad at me or anything because I'll have the money on hand. And so that'll be great. And so they'll make a deal between them. And this is the interbank interest rate. This is the interest rate that banks charge each other for these short-term 24 hours, 1 week loans, like short-term loans. They charge each other some interest rate, and that just sort of clears their books. People with extra money get to give it to some other bank and earn a little bit of interest income. Banks that are short of money can borrow from those other banks and get pay a little interest, but at least they don't get in trouble with the regulator. So that's fine. That happens all the time. Okay? But suppose it's not just an idiosyncratic thing with the bank. Suppose that it just happens that everyone in general was in a happy mood and they thought, I'm going to spend a lot of money on the weekend. In the country, everyone just got happy and the central bankers weren't expecting it. Everyone just said, I'm going out, I'm going to have some fun this weekend. But as a mass psychosis, it was probably, the TV show on Thursday night or whatever. Everyone just taking out more money from the bank than the banks expected them to, as a general rule across the economy. And so now all the banks, or most of the banks, or more, banks are on average 100,000 short at the end of the week. Well, what happens to them then? Huh? Yeah, what's going to happen? Like, they're going to go to the regulator. The regulator is going to say, you're supposed to have 5 million. All you got is 4.9. You are a bad, bad, bad bank. Well, there's likely to be some punishment of this, right? This is not great. And so one of the things, but central banks are aware that this happens. They don't want banks to count on it happening. And so what they do is the central bank will loan them that money. If there's no banks that will loan it to them, the central bank will loan it to them. The central bank can just make it up, right? They have the printing press. They can do that. The central bank will loan that money to them, but they'll charge a kind of high interest rate. So to discourage banks from doing this, right? From cutting it too close. And so that's an interest rate the central bank can play with. It can charge more for that kind of loan, or it can charge less for that kind of loan. If it charges more for that kind of loan, that will make banks not want to take out that kind of loan, and they will hold more in reserves. Even though they're only required to hold 5 million, maybe they'll hold 5.2 million to try to avoid that kind of thing happening. Right? Or you could lower that interest rate, and then banks would be more willing to cut it close. Okay? Now, if you're a bank and you're always doing this, you can also get in trouble, and they can start fining you, they can start taking away your rights, they can audit you every day, they can do other things to discourage you. But if it's just every once in a while, they just charge you an interest rate, and you borrow from the central bank. Okay. Another thing they can play with is the return they get. So suppose everybody is being cautious. And on average, all the banks they're supposed to have 5 million in reserves. They've got 5.1 million in reserves just because they're being cautious. They don't want to get punished like this. Then on average, they got this extra 100,000 lying around that's not earning them any interest. One of the things the central bank can do is they can take those as loans. Right? You can loan that money to the central bank. The central bank doesn't really want it, but if it wants to encourage you to have this cushion, right? It wants to encourage you to have high reserves, higher than the required reserves, they can give you an interest rate on this so that you're not so eager to cut it close. Right? Well, I don't mind if I have a couple 100,000 extra because the central bank will pay me something over the weekend as well. Right? And so by playing with those two interest rates, you can encourage banks to have higher reserves or lower reserves, which will affect the money supply as well. And so if, for example, you wanted to increase the money supply tomorrow, that would be a good way to do it. And that's very often those interest rates are played with a lot on a weekly, monthly basis to try to change the money supply in kind of a quick way. whereas these open market sales and purchases have more of it takes a while to work through the system, right? But another issue we've got is an issue that we have primarily in the last 15 years, since 2008. In fact, we know the date. If I can add a page here. And we have a situation like this. Here we've got our money. That's just the number of euros. Oh, that's a very sad euro. Okay, let me fix the euro. That's just too pathetic. We will try to do better. We got euros. Still not great, but it's euros. Euros, we know euros. And here we've got the nominal interest rate, the price of money, right? And then we went into a recession in 2008, and they really wanted to get us out of the recession, right? It was like a whole crisis, a whole big thing. And so they're trying to get us out of the recession. They want more investment so that planned aggregate expenditure will go up, and through the miracle of the government spending multiplier, they will have more output. Right? And so they're trying to encourage investment, meaning they've been trying to keep interest rates really low. Right? And so if you try to keep interest rates really low, you can, you move out the money supply, and if we draw money demand, it looks probably something like this. In particular, it gets like when it goes to zero, it doesn't ever really go below zero. Because if you think what happens, if we're way up here, if we're in a position like up here, and we've got a high interest rate somewhere up there, then what you're doing as a person who's thinking about holding money, you're comparing, well, I can take my wealth and I can put it into bonds or some kind of interest-bearing asset, and I'm going to get this interest return. Right? That's a very nice store of value. Or I can put it into something liquid like money, checking accounts, etc. And that won't pay me the interest, but I'll have my options open. Right? And that's nice. And so I'm comparing those two things. But then, when we start getting down to these very low interest rates, like in particular 0, but even like 0.1, 0.2, they're very low interest rates, then taking your wealth and putting it into interest-bearing assets isn't getting you anything. Like if interest-bearing assets are paying you 0, then you're giving up your liquidity and you're not getting really anything in return for that because the interest rates are so low, right? And so then money starts serving as a store of value. You can imagine that if interest rates were negative, that is, you had to pay people to hold your wealth, you wouldn't do that. You would just hold it all in your checking account, right? You would have everything in money, all of your assets in money, because putting it in an interest-bearing asset just loses you wealth. And so everything would go into money. And so money would not only be serving as a good medium of exchange, it would also be serving as a store of value. And then this whole kind of story breaks down, because if we change the money supply, it's not going to change the interest rate. The interest rate's not going to fall below 0 because people just hold money instead. And so we're in a situation where we put the money supply in. If we can undo this, put the money supply in. Right, that if we move the money supply right or left, it's not going to change the interest rate really at all. And this is what's in the jargon, and what's been very fashionable in macro circles for the last 10 years or so, is this is known as the zero lower bound, that you can't drive the interest rate below 0. It's in fact very hard to get it too close to 0. And so monetary policy becomes pretty ineffective. That like you can change the money supply a lot. You could triple the money supply, but you're not going to get any more investment that way because you can't get the interest rate any lower. And the reason you can't is because money is now serving as a store of value. I mean, it always does, right? That was the definition. But very liquid money, like checking accounts, is becoming a very good store of value, whereas in normal times, it's not a very good store of value. So you have this trade-off between medium of exchange and store of value in normal times. But in the last 10 years or so, you haven't had that trade-off. Medium of exchange and store of value have been kind of the same. And so in order to get better interest rates, you had to do risky things. And so money supply in this sense wasn't very effective. And all they really had to work with was these interest rates that they charged the bank if they went over, and the interest rates they gave the bank if they had a little extra. And so a lot of monetary policy in terms of trying to affect output has been through those channels recently. It's not looking like that's the near future, and sort of most of fiat money history, we've been sort of more in this kind of range where monetary policy behaves normally. That is, you increase the money supply, interest rates go down. You decrease the money supply, interest rates go up. That's kind of normal. But the last 10 years have not been like that at all. And a large amount of research and a large amount of policy discussions have been around what goes on with this zero lower bound. And things get weird, as you might imagine. Okay, what do we got? Okay, so those are our two caveats. But by and large, for normal times, and that looks like the kind of times we're going into now, we have a downward sloping money demand curve, and you can affect the money supply in the long term by increasing and you can affect interest rates by increasing and decreasing the money supply. Nominal interest rates at least. Real interest rates are more problematic, but if we think in the Keynesian world, where prices are fixed in the short run, we don't know how long the short run is, but if prices are stable in the short run, then increasing the money supply would decrease the nominal interest rate, which decreases the real interest rate, which encourages investment, okay? Which increases output. So we can affect output with the money supply if this convoluted chain of events all holds, okay? It hasn't held very well in the last 10 years because of this zero lower bound and the money demand being so close to zero and basically horizontal at zero. Okay. All right, that's money supply and money demand. Again, the reason we care about this is because you can potentially change investment. Let me just sort of draw that out. Add a page. Okay. We have, suppose, for example, money supply goes up. That's going to lower the nominal interest rate. That's going to lower the real interest rate. And that is going to increase investment, which should increase output. Okay. This bit here, we see on our money supply, money demand diagram. Euros, nominal interest rate, money demand, money supply. We shift it to the right, and the nominal interest rate goes down. Okay. This bit here we see on our planned aggregate expenditure diagram, the Keynesian cross diagram, where we have Y, which we're thinking of as income and output. And then the third is expenditure. We've got our 45-degree line where Y is equal to planned aggregate expenditure. And we've got planned aggregate expenditure itself, C plus I plus G plus net exports equals planned aggregate expenditure. And when investment goes up, this curve shifts vertically up by the change in investment, and we see output going up. Right. What we don't see is this, because we haven't seen how money will affect inflation yet, but we're in the world of Keynes here, where prices are sticky in the short run. And so this is, again, a crucial assumption. But if we have this assumption, we have these steps that causes output to go up. Now, I would suggest to you that you go through and do the same thing for the money supply decreasing, and just to fix ideas in your own head. So get yourself a blank piece of paper, draw the chain, draw the two graphs, and see what happens when money supply goes down, to see the same chain. It's a long chain, and there are various places where it can go wrong, right? We talked about one just a minute ago. We said this can go wrong, right? This can go wrong because we're at the zero lower bound. You can increase the money supply, but interest rate doesn't fall, in which case money supply doesn't affect output at all, right? Which has been a problem in the last 10 years because we really want to increase output in a recession, but we haven't been able to. Okay. All right. Now, the one last thing I want to say in this chapter, this is the end of the chapter, but one last thing I want to say is that a lot of the questions on this chapter that you would see on an exam are pretty straightforward in the sense that, like, if you don't know it, of course you don't do it, but students who look at the questions and try to solve them, mostly they can figure them out. But there's one type of question where a lot of well-meaning students who have been studying and working at this can sometimes not be able to figure out the question, much less the answer. Or how the question relates to any of the material. So I want to go over that kind of question and do one of those just to see how one of the harder questions can be answered using the kind of material that we've got. Okay. We already covered this. Let's see if we got it. Where are we? Here we go. Here's a sample question. The required reserve ratio is 10%. The desired reserve ratio is 20%. Banks have $10 billion in reserves and $5 billion in cash is held by the public. What is the money supply? Now, there's a whole series of these questions. They're all a little different. There's various ways you can come at it, but it's the same, trying to get at the same information. And so they're kind of answered in the same way. It's about understanding how the banking system works and what the money supply is. But there's a lot of bits in a question like this. So this is like one of the harder questions that you could get on this sort of thing, on this chapter. And so don't think this should be obvious, because it's not. But it is something that you can figure out if you put all the pieces together, right? So it's one of the less direct questions, but it tests lots of different things, right? So, think of it as one of the harder questions, and you will not be wrong. You will not be wrong. So how do we go about this? So the first thing to notice is that what is the money supply? Well, money supply is going to be bank deposits plus any cash held by the public. So really what we're trying to figure out, we're told how much cash is held by the public. That's $5 billion. So all we really have to figure out is how much is deposited. And that's going to be the money supply. Right? Deposits plus the cash. Because how much money do you have? It is the cash in your wallet, and it's anything you have in the bank account. Right? That's your total money. And if we just add up everybody's total money, that's going to be the total money. So we have to figure out how much is deposited. And we look through there. They told us the cash held by the public, so that's lovely. But they didn't tell us the deposits. So we have to figure that out, right? They did tell us the reserves, so that's nice. And they gave us two of these reserve ratios. So we have a required reserve ratio and we have a desired reserve ratio. What are those on about? Well, a required reserve ratio is saying you have to have at least 10% of all your deposits in a very liquid form. Various rules on this, but we can think of it as just cash in the vault. Right? There's some other things that you can have in practice as well, but it has to be something very liquid and easy to get at. So we'll think of it as cash in the vault. We have to have at least 10% in the vault. But if we want, we can have 100% in the vault, right? We can be Horace Bank. We can have 100% reserves. It's totally up to us. We won't be profitable unless we have a clever scheme like them, but we can do it. So we're allowed to have more, but we're not allowed to have less, okay? And then we're given this desired reserve ratio. That's 20%. This is saying the banks want to have 20%. They want to have 20%, but the law says they have to have at least 10%. Well, that law doesn't affect them because they want more, right? This is, the law says that you're not allowed to murder anybody, but you don't want to murder anybody, so you're fine. The law doesn't really affect you. It's only when you want to murder people, but you can't, that it's a problem. Here, they want to hold 20%. You have to hold 10%. It's not a problem. So in fact, if I find my pen, this number is entirely irrelevant. It has nothing to do with nothing because they want to hold more. Now, it could have been that the desired reserve ratio was 5%, in which case they would have to obey the law in our little theory. And so the 5% would be irrelevant because they want to hold 5%, but they can't. So you're a law-abiding person, but you want to kill 12 people. The law says you can't kill anyone, so you're not killing anyone. So you're 12 people murder, rampage, desire is totally apropos of nothing because you're going to obey the law in this story. I don't know you and your life. But so it's the higher of the two that matters. So there's a 20% reserve ratio that matters. So these banks are going to keep 20% in reserves. So for every 100 that's put in the bank, they're going to keep 20 in reserves, right? So let's do that. If I take this thing off 1 second. So we have if 100 deposits, we get 20 reserves. And so deposits are 5 times as big as reserves. Right? And we're told that we have 10 billion in reserves. And we know that deposits will be 5 times that big. So there's got to be 50 billion in reserves. Right? So we have the money supply, 50 billion in deposit is deposits. It's plus cash. Reserves are 10, so deposits are 5 times that big. Deposits are equal to 50, and then cash on hand is 5 from here, and so that's equal to 55, and that's the money supply. Okay, so it's just putting together how reserves work for banks, the desired reserves plus the required reserves and how those work, the bigger one being the operative one, and then looking at knowing that, how to find deposits from that, right? And then knowing that money supply is deposits plus cash, right? And so you have a bunch of things you have to put together here, but doesn't look like it's related to the information, but it's really just putting together all this stuff to come up with money supply. If you look at the old exams, there'll be a bunch of questions like this. They're all a little different. Sometimes you're supposed to find the money supply, sometimes you're supposed to find the reserve ratio, sometimes you're supposed to find the cash, but it's all putting together this sort of same information. How are we doing here? And that's just what I said there. Okay, and that's the class. I will see you on Friday, back in person again, thank goodness, and yeah, see you then.